Good morning, good afternoon, good evening, and good night, depending on where in the world you are joining me from. I am Illuminati, and this is the Crypto and Cognac podcast show, as always, live every Thursday, 7 p.m. Atlantic Standard Time, sharp, right here on YouTube. And I see in the comments blazing already. You know what that means? It means that if I'm here, Stevie here. And if Stevie here, Henny there, right? And if Henny there, it's time to have a drink. It's time to chop it up. It's time to talk crypto while drinking some cognac, right? Guys, can I still say Happy New Year? Yeah, man. Still the first couple weeks of 2026. Cheers to life. Cheers to a new year. Cheers to you and your family. May your wallet be filled with Satoshis. Guys, 2026 and things looking exciting, right? Things looking in a way that things haven't looked like in a little bit, right? And today we are talking about something that I've been kind of circling for a while, right? Because it really sits at an intersection of conviction and caution, right? If you have been in crypto for a little bit or a little bit longer than a little bit, you have heard it whispered, you've heard it tweeted, you've seen it tweeted, you have seen it maybe shouted, right? The whole idea that we are somehow in some kind of supernatural Bitcoin super cycle, right? But is that real, right? Or is it just another version of the same old thing dressed up in nicer suits, ETFs, and institutional press releases, right? Is this just a shinier version of the same old thing? So tonight, I'm going to attempt to break down the arguments between whether we're in a super cycle, whether we're not in a super cycle. And then, we're going to look at the evidence and try to come to a conclusion, right? Now, let me figure out what that even means. What is a super cycle, right? What is, crypto has all these buzzwords, right? And we never really know what we're actually talking about. So, to understand a super cycle, first we must understand what preceded a super cycle, and that is the traditional 4-year market cycle, right? Which is very much tied to the Bitcoin halving event, right? Which is usually, usually characterized by an accumulation phase, an expansion phase, a euphoria phase, and then a brutal correction phase that sends us into bear market, and then the cycle repeats. So that's what we've been used to, right? Since, I guess, 2009, right? All the way coming forward, every halving cycle, we have been used to this. Now, a super cycle, on the other hand, suggests that instead of these major ups and major crashes, what we're going to have is a longer lasting bull market, lot shallower drawdowns in market movement, more sustained demand rather than significant moments of fear. And even these significant moments of fear are not going to be as impactful. And critically, the main difference is that we are going to break free of that 4-year halving narrative. Is that even possible? So those things, in my humble opinion, are what would take us into a space where we can say we are no longer tied to a Bitcoin 4-year cycle and we are experiencing a super cycle, right? And I think that is going to be representative of Bitcoin's, I guess, graduation from a speculative asset to a more structured or structural asset. But if history has taught us anything, is that Bitcoin does not care about our graduation ceremonies. Bitcoin does what Bitcoin wants when Bitcoin wants, right? But we're going to touch on it. So the first thing, right? People are saying that one of the things that is evidence of this new super cycle, or one of the things that is creating this new super cycle, is that spot Bitcoin ETFs have introduced new buyers, introduced new level of demand, a new class of buyer, a new class of intermediary that supports that class of buyer. And all of this lends itself to less emotional reactions when it comes to periods of corrections, periods of concern, and when we move away from the green candles, right? And during those periods of red candles, these institutions backed by their investors are going to be allocating more money trying to buy up the demand, or the shallow demand that is in the market. And because of that, we are not going to see these kind of crazy 60, 70% drawdowns. Now, you might say that there's evidence of that last year. I mean, we had one of the craziest liquidation events of all time in the history of cryptocurrency, and still we didn't see a 60 or 70% drawdown. We saw 30, 35, I think as high as maybe 37%, right? Next, we're not gonna see retail FOMO like previously. What we're gonna see is a little bit more structured adoption by pension funds, by asset managers, by family offices, and they're not gonna come all in all at once. They're gonna be allocating piecemeal, always trying to get the best pricing, right? So we're not going to see a bunch of money flood into the market. Additionally, the size of the Bitcoin market, the size of the crypto market is significantly larger than what it was even as far back as recent as 2021. So it takes so much more money to move the market in a particular way. Now, the idea that, and the supply shock, I think, as the Bitcoin block rewards shrink, what we are seeing is that the supply shock is not as significant, right? So moving from, let's say, 12 Bitcoin to 6 is very different to moving from 3.5 Bitcoin to 1.75 Bitcoin, right? So we also have those things influencing the impact. So, and then I guess we have a lot more historical data in terms of what has happened before. People have the opportunity to zoom out. People have the opportunity to see that, you know what, this has happened before, we're going to recover again. And I think because of that, we are seeing less people capitulating during these times and just deciding, you know what, I'll hold on, right? Even if we're in the 4-year cycle, I'm going to hold on to my BTC because once I have it, I can't lose it, right? And I'll wait 4 years and I'll be okay. So I think all those things are shifting the movement. And I think it's also shifting the narrative around participation in Bitcoin and crypto, I think we've moved from that place where it was kind of like get into crypto and you're going to become rich, you're going to become super wealthy. And I think we've moved into a space where the conversation now is more like, how do I protect what I have? How do I protect against hyperinflation? How do I protect against the erosion of the fiat currency? And I think the narrative now has moved away from how do I get rich quick to how do I protect myself from going absolutely broke? How do I stop myself from being poor? I think it's more protection against the downside. It's less about Lambos and more about I guess living, and I think everything that we are seeing recently as the last week, as we saw what has happened to the Iranian currency, where it has been debased significantly. I mean, Bitcoin, I think price compared to the Iranian dollar is something like 10,000x over the last couple of weeks. So you can imagine someone who has or who had millions of dollars in that currency is now effectively poor. You could have had $100 million saved in Iranian dollars. You could have been a multi-millionaire in Iranian dollars, and in a matter of seconds, a matter of days, right, you are effectively poor because you have no real assets to hedge against that kind of market movement or fiat dollar debasement. So I think all those things have shifted the dynamics of the market, and that is why when we were at 10 on the greed fear index, we still was hovering at 90,000, 88,000, and now we're back up at around 97,000 per BTC, and we just had 65, in terms of the greed fear index. So I think even with the significant moves on the fear and greed index, we aren't seeing a similar corresponding movement in terms of the price action, right? So I think the long and short of it is that ETFs, yes, macro still rules everything. There are tons of different ways that you could see things, but honestly, I think until we see a full 4-year cycle between the last halving and the next halving, and can really look back and quantify the data of the movement between those two periods, and maybe even two sets of halving cycles, we really cannot say definitively that we've broken free of that cycle. In a mature market, it just may look like the same actions but just less volatile, right? So it may be what used to be parabola, what may look different. I mean, after the last halving cycle up to the last market top, that was 8x from the last all-time low of 16,000. So we can't say, I mean, what other asset do you know goes 8x in a couple of years? Is that not parabolic movement? So I think maybe what needs to change is our perspective around the dynamics of the 4-year cycle. I still believe that the 4-year cycle has a lot of value still in guiding us. But what am I doing? The same thing I always been doing, bro. A little bit here, a little bit there. $10 BTC every month, right? Not 10 BTC, I wish, but $10. That's what I doing. Dollar cost averaging. You understand? I don't have the big dollars like Steven to throw all in. But I believe now, like I believe then, like I believe always, adoption is inevitable, right? And one day, my $10 might be worth $15. And that's all I'm looking for, right? Because it wouldn't be worth $15 anywhere else. Because the things that would give me that kind of return, I can't just invest $10, right? The small man like me can't invest in those things. And the things that I might be able to invest in that could give those returns that I can invest at $10 might give me 10 to life as well. So I staying clear of those two. So for me, BTC, crypto is the way. Again, we didn't say it at the start, but it's never too late to ICE rule. Information, conversation, education, not financial advice. Me, I'm not a financial advisor. This is not a financial advisory podcast, right? Just Illuminati, chopping it up. It's Stevie J, you on the way. And guys, that's my time. Illuminati, OUT. Guys, have a blessed one. See you all next week. Right? Pump is pump. Carnival gifts. Cheers.